start recording, and let's look at chapter 6. So chapter 6 is really divided into 3 parts, in my opinion, 3 parts. And I like to go out of order, right? So one part is the income statement. Notice now the income statement, we're going to call it by a slightly different name, multiple step income statement. We'll take a look at it in a minute. What we've been doing up to now is called the single step income statement. In other words, you only had one step to get to net income. You took total revenue minus total expenses, gave you net income. One step. Now we're going to see the income statement in multiple steps, more than one. And we're going to see that there are several different subtotals on the income statement. Now, why do we do this? Well, we're trying to make the income statement, like all the financial statements, we're trying to make it more useful to the people that use it. So those subtotals don't exist just to cause problems for you. Those subtotals are there because they aid in analysis of the income statement. Now, you know, unfortunately, we don't spend a lot of time with the analysis. It's the type of thing that the more accounting classes you take, the deeper you get into that. I mean, I just am trying to get you, to where I think you need to be before you get to that next step. But the income statement is one section in the book that we have to address. You're going to see that we have some new accounts. And as a result, there are more journal entries to learn. So that's something we'll also do today. That'll be the second part. So income statement first, the supporting journal entries, I guess you could say, second. And then the third part is what they kind of list first, which I don't understand, because you really need to know why you're doing what you're doing rather than just to show you something. They show you that there are different ways to calculate the number that we use for inventory. So that's the third part. And I don't know if we'll get to that today, right? But we will definitely get to it next time. And, we have some time with this chapter, so we can take our time with it. So let's take a look at that income statement, multiple step income statement. Right, and this is something that you probably should take some time reading. Now, they explain to you cost of goods sold, right? We've seen cost of goods sold before. Just briefly, cost of goods sold applies to companies that sell merchandise, whether they manufacture the merchandise or they buy the merchandise from somebody and resell it, right? They show you here how to calculate cost of goods sold. And this will be helpful when we get to the third part of the chapter, but let's talk about it now for a second. How do we calculate cost of goods sold? We're going to see that there are 2 systems to account for inventory. One is called the periodic method, and the other one is called the perpetual method. Now, this is how you calculate cost of goods sold under the periodic method. So how do you do that? You start out with your beginning inventory. In other words, what did you have on your shelves at the beginning of the period? In this case, it was $20,000. How much more inventory did you purchase during that period, right? And they're using a year. So this would say this would be on January 1st. And this is activity that took place at various times during the year, not all at once, right? But at various times during the year, and it adds up to $90,000. So what did you have available? 20 plus 90 is 110. You had $110,000 worth of merchandise available to sell. If you look at how much inventory you have at the end of the period, 30,000, and how do you arrive at that number? Well, you count it, right? And that's, again, that's the third part of the chapter. We're going to talk about how do you get to this $30,000, but you count it and say it adds up to $30,000. 110 minus 30 is 80. Cost of goods sold is $80,000. So how do you calculate cost of goods sold? You take the beginning amount of inventory, you add the additional purchases you made to inventory, that gives you this available for sale number, and then you subtract the ending inventory, right? Inventory not sold, subtract the ending inventory, and you get the amount that was sold, the cost of goods sold, right? And this is the number that goes on the income statement. Right, and here they're showing you an income statement for Best Buy. Right, let's take our time and go through the statement. So the first line is revenues. Now notice what they did here. They took revenues, which is sales, right? And Best Buy. Right, so you know what Best Buy does. You know, just imagine when you open the front door to Best Buy, all the stuff that you see in there. Revenues minus returns, allowances, and discounts. Remember we talked about returns, allowances, and discounts in the last chapter? Returns, I think it's obvious. The customer physically brings the merchandise back and we either give them their money back or we give them credit. Allowance means that we let the customer keep the merchandise, but we just take something off the price just to make them happy. And discounts really doesn't apply to people like us, right? It's like it's something that happens in a business-to-business transaction. So let's say Best Buy has some customers that aren't retail customers like you and I. They are, let's say they're other stores, for example. And we want to encourage the customers to pay us on time or to pay us early. So we give them a discount. Remember, we saw that in the last chapter. That was called sales discounts. Remember that revenue accounts have a credit balance. And these three things were what we would call contra revenue accounts. So these would have debit balances, right? So we're going to go through journal entries later, and you're going to see this. Cost of goods sold, we just talked about. So 39,403 minus 29,963 is 90,440. And notice they have a name for that. They call that gross profit. Gross profit. So what is gross profit? It's the profit that we make just on the merchandise, right? So if something costs me if I sell something for $100 and that thing cost me $60, my gross profit would be $40, right? That's what gross profit means. How much profit did I make just on the merchandise? Now that doesn't include any of the other expenses that I have, those things that we call operating expenses. Operating expenses would be things like advertising and salaries and rent and utilities and so forth. So in this particular case, that came out to $75.86. And if I subtract $75.86 from $94.40, I get this $18.54. We call that operating income. Operating income. So what does that mean? What does that term operating income mean? It means how much profit did the company make doing the thing it went in business to do. What did Best Buy go into business for? To buy and sell electronic merchandise. What did Best Buy go into business to do? To buy, that's the cost of goods sold, and to sell, that's the revenue, electronic items. How much profit did they make doing that after all their expenses? In my opinion, this is the most important number on the income statement, right? Everybody gets obsessed with net income, but really this is the important number, because when you want to invest money to buy a stock of a company like Best Buy, why are you buying that, right? You're buying it based on how good they are at buying and selling electronic merchandise. Now, there could be other things that they do or they have that affects net income, but has nothing to do with the main reason they're in business. In other words, the main reason they're in business is this number. The main reason they went into business is to buy and sell electronic items. You know what they sell, right? But they could have other types of income and expenses that have nothing to do with that. They could have other types of income and expenses that have nothing to do with that. Nothing to do with buying and selling merchandise. So here you see some items. Gain on sale of investment. Right, let's say they had some extra cash and they bought some stock of a company and they sold that stock and they made a profit of $3. It's actually 3 million, right? See, it's in millions, but it's just easier to work with the smaller numbers. So they had a gain on that investment of $3 million. And then they had other types of income, investment income. Maybe they had some interest on bank accounts, or maybe they got some dividends on other stocks that they own, right? So they had investment income of 31. And then they had interest expense of 72. Now, you might say, well, wait a minute, why did they put interest expense here? Should interest expense go up here with the other expenses, right? That's what you would normally think. But here's the reason interest expense goes down here on the bottom. Not everybody borrows money, right? The only way you can have interest expense is if you borrowed money, right? Well, maybe you know people that borrow lots of money. They like to have a fancy car. They like to wear fancy clothes. They always have the newest phone, right? Maybe you know some people like that. And then maybe you know some other people that don't do that, right? People you might call thrifty or stingy or even cheap, you might say. Well, people like that, it kills them to pay interest, right? They don't pay interest. So how would I compare one company that borrows money to another company that doesn't, right? Some companies don't need to borrow money. They've got plenty of cash to keep their business going. Other companies are forced to borrow money. So how would I compare two companies like that? If I want to compare a company's operating income, company A that borrows money with company B that doesn't, well, how would I do that? If I included the interest expense up here, one company has it, the other company doesn't. So it makes it harder to make, a meaningful comparison of this operating income number. So that's why we like to break interest expense out separately and put it down here on the bottom. Yes, it's still an expense. Yes, it's still part of net income, but it's not part of this operating income number. Now here's where it gets a little confusing, right? Because you're adding and subtracting. how do I come up to this 1816 number? I start out with the 1854, add 3, add 31, and subtract 72. And when I do that, I wind up with this 1816 number, which we're going to call income before taxes, which is kind of a meaningless number, right? But, you know, we need to call it something, I guess. And then how much tax do you pay on that 1860? In this case, it was 609. And most problems, they're going to give you that number. You're not going to become a tax expert here. And notice again that income tax expense is all the way down here on the bottom, right? Income tax expense is not an operating expense. Income tax expense is non-operating. Income tax expense is only a function of your pre-tax income. So some companies that have a lot of pre-tax income pay a lot of taxes, and companies that have small pre-tax income pay less taxes. So that's why you don't want to put this income tax expense with the operating expenses, because it's kind of, it's kind of meaningless actually. And then if I subtract the income tax expense from the income before taxes, I get net income. Net income 1207. Right? So notice 1 subtotal, 2 subtotals, 3 subtotals, 4 subtotals. So we don't go from revenue to net income in one step like we did previously, right? We've got 4 steps before we get to net income, right? And that's what makes this complicated. Where most people have problems is down here. Some people just have trouble dealing with this, right? So that's why I pointed out to you in advance so that you know to take to be careful with it. All right. Now let's do a problem for homework. We had problem 7A. Problem 6-7A. Okay. So Baskin-Robbins, you've all heard of, is one of the world's largest specialty ice cream shops. The company offers dozens of different flavors. Assume that a local Baskin-Robbins, right, not the parent company, but just a little Baskin-Robbins shop located in Raleigh, North Carolina, has the following amounts for the month of July 2021. So you see what they have listed here. Prepare a multiple step income statement for the month ended July 31st. And then they want us to do some analysis, right? Number 2 and number 3 have to do with some analysis, but let's get past this number 1 first, right? Prepare the multiple step income statement for the month ended July 31st. So what am I looking for? I'm looking for sales revenue minus cost of goods sold is gross profit. Then I want to look for my operating expenses. Operating expenses are things like salaries. Oh, I had sales returns in there, right? I didn't see that before. So I have to subtract the sales returns from the sales revenue. Utilities expense is an operating expense. Remember, income tax expense goes all the way down on the bottom. Interest income, non-operating, right? Remember we had that section called other income and expense. Rent expense is operating, interest expense is not. And then they gave us the inventory, the beginning of July and the end of July, right? We don't need to do anything with that yet. We may need to use that when we get down here to the analysis. So let's look, I have a worksheet here, Excel. let's take a look. So, Baskin Robbins, multiple step income statement for the month of July 2021. Okay. So up here at the top, look. So up here at the top, let's call this section net sales. I don't know what just happened, but here we go. Net sale. Oh, what the heck? Net sales. Right, and what is net sales made up? It's made up of revenue. Let's call it sales revenue. Right, and sales revenue was 69,800 less sales returns. Right, now sales returns was 1,100. So if I subtract 69,800 minus 1,100, I will get 68,700. And we're going to call that number net sales revenue. Right? So just go back to that Best Buy example. Now, Best Buy, what they did, they just gave you what the net revenue was, right? They didn't show you the returns or anything. Next, cost of goods sold. Right? And we didn't have to calculate it. They gave it to us, 28,700. So if I subtract net sales minus cost of goods sold, I get gross profit. Right? And that's $40,000. Gross profit is $40,000. Next, I have the operating expenses. What were the operating expenses? If we go back to look at the problem, right, it's salaries, utilities, not income tax, not interest income, rent expense, not interest expense, right? Those were things that came later. So just list them. Salaries expense, utilities, and rent. If I add those three things together, I get 24,000 total operating expenses. And then if I subtract the operating expenses from the gross profit, 40,000 minus 24,000 is 16,000. That is operating income, okay? And again, operating income, in my opinion, the most important number on the statement, because it tells you how good they were at doing the thing that they went in business to do. What did Baskin Robbins go into business to do? To buy and sell ice cream. They made $16,000 doing that. They made $40,000 just on the ice cream, right? Just if you take the difference between what they paid for the ice cream and what they sold it for, they made $40,000 just on the ice cream. But they have a store to run. They have people they have to pay, employees. They've got to keep the lights on and the air conditioning and the heat, right? They got to pay rent to their landlord. So after they did all of those things, they made a profit of $16,000. But then we have other income or expense. So did we have anything else, right? If you go back to the problem, they had what? They had some interest income and they had some interest expense. Means they had to borrow money. Interest income. That was $3,300. Interest expense. Well, 3,300 minus 400 is 2,900. Right? And they just call that total. Now, in the Best Buy example, they did that a little bit differently, right? In the Best Buy example, they put the 3,300 here, they put the 400 here, right? And you just added those three numbers together. But here they did it a little bit differently. They took interest income minus interest expense, gives you $2,900. And that's a positive number, right? Because the 3,300 was greater than the 400. Could be the other way. Sometimes the interest expense could be more than the interest income, in which case you would have a negative number here. So if I take this 16,000 and I add this 2,900, 18,900 is the income before taxes. Income tax expense was $6,000. 18,900 minus 6,000 is 12,900. And that is your net income. $12,900 is your net income, right? So if we just take a step back, look at the whole thing. Net sales is total sales minus returns is net, right? And if you want to say how many subtotals were there, well, this is one subtotal right here. Oh, let's just say one. And then if we subtract the cost of goods sold from the net sales revenue, that gives us gross profit. That we could call that a second subtotal, right? And then if we were to subtract the operating expenses from the gross profit, that gives us operating income. That's a third subtotal, right? And we could call that most important. Right? And then if we get the income before taxes, that's a fourth subtotal. And then income is a fifth subtotal, right? So it took us 5 steps to go from revenue to net income, as opposed to 1 step, which is what we learned prior to this. So there's your income statement. Okay. Now, they want us to do some analysis, right? This was part 1. Part 1, right? Now, part 2 and 3 are analysis. I'm going to do part 3 first. It's easier. Go back to the problem. Calculate the gross profit ratio for the month of July. And you just got to be careful when you're doing these problems on Connect, because rounding can sometimes be an issue, right? So you need to pay attention to what they tell you to do with rounding. So how do I calculate the gross profit ratio? Gross profit ratio is equal to gross profit divided by net sales. So in our example, the gross profit was $40,000. The net sales were $68,700. I need to get the calculator out. Comes out to 58%. It actually comes out to 0.58, which is 58%. And I'm rounding it because it was actually 58,224,163. Right? So you have to see what they tell you to do with rounding when you do the problem. They might say just round it to like this, or they may say round it to 2 decimal places or 4 decimal places. You just need to pay attention to what they want you to do. So that's the gross profit ratio. Now, part 2, which is a little more difficult. Let's go back and take a look at that. And again, I'm not taking you through the pages where you do that, right? Here they do. Here they walk you through, right? Here's how you calculate gross profit ratio. Here's how you calculate the other ratios they want you to do, right? You can go back and look at the example. I'll just try to do it based on our example here. Part 2, the inventory turnover ratio. Inventory turnover ratio. Now, let's go back to gross profit ratio. It's saying that for every dollar of sales, net sales, for every dollar of net sales, 58 cents is gross profit. 58 cents is gross profit, right? So here, let's look up here. They didn't ask you to do this, right? This is me. Trying to make some sense out of this, right? If this number represents 100%, and this number represents 58%, right? Because we said that for every dollar of sales, 58% is gross profit. Well, what does cost of goods sold represent? 100 minus 58 is 42. Right? 42. So out of every dollar of sales, your merchandise that you sold cost you 42 cents, which means that you made a profit of 58 cents, a gross profit. And you can do the same thing down the line, right? So when you get down here to the bottom, you could say, well, what is net income over net sales, right? That's another ratio. That's called the, well, it's called the net income ratio. If this was the gross profit ratio, this would be the net income ratio, right? They didn't ask you for that, so I'm not going to do it. But I'm just trying to show you here what those numbers mean. Sometimes you'll see financial statements like this, and these are called, when you see this, this is called common size statements. When you see them expressed as percentages, it's called a common size statement. Because think about it for a second. How could you compare a huge company to a small one that may be engaged in the same kind of business, right? So how do you take a huge company like an Apple, for example, and compare that to a smaller company that does the same kind of things that Apple does, right? This is one way that you would do that if you were trying to make the comparison. Okay. So this inventory turnover ratio. Now, why are we bothering with this? Because it's important to know how long it takes you to sell your inventory, right? So take, for example, something like ice cream. Well, what happens to ice cream if it stays in the freezer too long? Do you ever have ice cream that was in the freezer too long? Doesn't taste very good, does it? So if I'm a company like Baskin-Robbins, I want to make sure that I always sell fresh, nice tasting ice cream. So I want to make sure that I don't hold on to it too long, that I sell it relatively quickly. If I'm selling something like cement or steel, then I'm really not so concerned with that, right? Those are things that don't go bad. Those are things that I can keep in a warehouse or even keep outside for long periods of time. Doesn't matter so much. But some items that are perishable, I want to make sure that I can sell them right away. So how do I calculate inventory turnover ratio? I take the cost of goods sold and I divide it by the average inventory. Now, in our case, cost of goods sold was what? What does it say here? Cost of goods sold was $28,700 divided by the average inventory. Go back to the problem. Remember they gave us inventory in the problem? You might have said, what the heck did they give us that for? So they gave us the beginning inventory was 2,300 and the ending inventory was 1,100. So what I have to do is average these two numbers. How do I average these two numbers? Well, I add them together and divide by 2. So what I'm going to do here is I'm going to take 2,300 plus 1100, which is equal to what? 3400. And I'm going to divide that by 2. So that's 28,700 divided by 3,400 divided by 2 is 1,700, right? 1,700. And if I do that, it comes out to 16.9. What does that mean? 16.9 times. In other words, it means that my inventory turned over 16.9 times. Again, I don't know if that's good or bad. I need that to compare that to other companies that do the same thing that I do to see if I'm better or worse than them. But 16.9 times is pretty fast, which is good, right? Because we want to make sure that we're selling fresh, nice, good tasting ice cream. Now, they don't show you this, but there's a way to break that down in days. And how would you do that? Well, most accounting books assume there are 360 days in a year. Some say 365, right? But some say 360. 12 months, 30 days a month is 360 divided by 16.9. What does that come out to? 360 divided by 16.9 comes out to be 21.3 days, right? So what does that mean? It means it takes this Baskin-Robbins store, it takes them roughly 21 days to sell out their entire inventory. And then you would have to say, okay, well, what's, what happens to ice cream over 21 days? Right? Is it still good? Is it still fresh? Does it still taste good? Right? So this is me showing you this, right? This is, I didn't see this in the book, but I think it gives more meaning to this 16.9. 16.9, someone might say, what the heck does that mean? Well, what if I told you 21 days? Doesn't that have more meaning? Right? So that's how you calculate inventory turnover ratio. It's cost of goods sold divided by average inventory. How do you get average inventory? You take the beginning plus the ending, add it together, and divide by 2, and that's how you get average inventory. Right? So that's the section of the book on the income statement. Now we want to look at the journal entries, recording transactions. Okay, so here they're showing you inventory transactions for a year for this company, Mario's Game Shop, right? And I guess they sell video games. I guess it's safe to assume that. And they say that these are the same transactions that are shown in illustration 6.5. Okay, well, yeah, see, this illustration here is to calculate inventory numbers, right? Which we don't want to do yet. We want to do that last. So now we want to look at recording transactions. Now you're going to see up here, if you look at this, there are 2 ways of keeping track of inventory. One was called the periodic method. We talked about that a little bit at the very beginning when we talked about how do you calculate cost of goods sold, right? You take the beginning inventory, you add the additional purchases of inventory, and subtract the ending inventory, and that gives you the cost of goods sold. That's the periodic method. So under the periodic system, you calculate cost of goods sold. One of the weaknesses of that system is you do not continually keep track of the inventory, right? You do not continually keep track of the inventory. So during the year, you really don't know exactly how much inventory you have, which is a weakness. But you got to remember that that periodic system was created during a time when people didn't have computers like they do now. When I went to college, which was a long time ago, we used the periodic system because that was the most common system that was used at the time. There's another method called the perpetual method. And under the perpetual method, you keep track of inventory on a perpetual or continuous basis. So any given day of the month, of the year, you know exactly what you should have in inventory. This is superior. But again, this method is really dependent on some kind of automated system. So when you go to the store to buy something, right, when you go check out at the cash register, all the items are scanned. Well, yeah, I guess one of the goals of doing that is to know how much to charge you for the items. But the other goal of that kind of inventory system is so that the company knows exactly what's selling day to day, even hour to hour. They know exactly what's selling. They know exactly what they have to do to restock what they want to put back on the shelves. They know exactly how much they have left of a particular item. So they have a good idea of what they sold, but they also have a good idea of what they have left. So notice it says here, technological advances in recent years have made this system simpler and more cost-effective for most companies. Back when I was a student, right, I'll tell you, 1970s, right? Back then, there were no computers, companies had a computer, it took up a whole room, and they just didn't do it. Now, every one of us is walking around with a computer in our hands these days. Our phones are computers, right? That just didn't exist then. So as a result, we use the periodic system, but the perpetual system, yeah, it existed back then. Don't get me wrong. It was there, but it was hardly ever used. So let's take a look at some of the journal entries that get made, right? And then we'll do homework problem. We will do it ourselves. So when you have a sale, when you make a sale, now this is an example here. I'm looking sales on account, right? Because I see accounts receivable. So on July 17th, right, if I go back to look at, again, I don't really have to do this in that much detail, but here, they're saying that on July 17th, they sold 300 units for $15 each. That's $4,500. Debit accounts receivable and credit sales. Right? Now, that's something we learned how to do a long time ago. Debit accounts receivable and credit sales. But now we're going to have to record the cost of goods sold. You see, if we're going to keep track of the inventory on a perpetual basis, it also means we're going to have to do the cost of goods sold on a perpetual basis. So we debit cost of goods sold and credit inventory. So when you make a sale now, you have two entries to make. Debit accounts receivable, credit sales, debit cost of goods sold, credit inventory when you make a sale. Okay, I am not liking this example they have here. Now, what happens when I go out and purchase more inventory? What entry do I make for that? Here's an example of that here. So here it says October 19th, Mario purchased 600 additional units for $6,600. How do you record that? Debit inventory and credit accounts payable. Right? Debit inventory and credit accounts payable. So what entry do you make when you sell? Debit accounts receivable, credit sales. Debit cost of goods sold, credit inventory. What entry do you make when you buy inventory? Debit inventory, credit accounts payable. Right? Those are basic entries. Let's take a look at a homework problem where maybe we'll see more of it. Now, the problem that I picked, I believe, was problem 3A. Problem 3A. Where are we? Oh, where am I looking? Sorry. Okay, now look what they want us to do. Look at the requirements. Assuming that City CD uses a perpetual inventory system, record the transactions, and then they want us to prepare just the top part of the income statement up through gross profit. So at the beginning of July, CD City has a balance in inventory of $3,400. The following transactions occurred during the month of July. Okay, so we can see here the kind of things they do. They purchase CDs, they pay freight, they return CDs, they pay for the CDs, they sell some, they get paid, they purchase some more, they sell some more, right? So you get the idea. Imagine you had your own little store. What are the kind of things that would happen on a day-to-day basis, right? So let's set this up like a journal. Date, account, titles, debit, and credit. Okay. So this, let's just note what this is. This is problem 6-3A, right? And this was on page 332. Okay, so the first transaction we had was on July 3rd. And purchase CDs on account from Wholesale Music for 2,300 terms 110 and 30. Now, we're a company that buys and sells CDs, right? Not that anybody does that anymore, I don't think, but imagine that we did. We buy and sell CDs. So anytime we buy CDs, that's inventory. So we're going to debit inventory. And that was for $2,300, right? And what are we going to credit now here? Now, if we were paying cash, it would say, right? Paid cash. But what does it say? It says terms 110 and 30. Do you remember what that meant from the last chapter? Right? That's a discount or a potential discount. So I'm buying this stuff on July 3rd and I'm not paying for it yet. If I can pay within 10 days, I get to save 1%. If I pay longer than 10 days, then I got to pay the full 2,300. So that's accounts payable. $2,300. All right, 2,300. And let's see if we could do this. Sorry about that. My Excel skills are not great. All right, well, here, this is what I'm trying to do. All right, I want to call this inventory. Inventory, right? Kind of an awkward way of doing it. Okay, now, when the problem started, they told me what? That inventory was $3,400, right? This is a T account for inventory, right? So they told me that inventory was $3,400. And we just now added 2,300 to that, okay? So on this particular day, on July 3rd, how much inventory did I have in stock? I had what? $5,700. I had the 3,400 that I started with, plus the 2,300 that I just bought. Certain things I'm going to keep track of, certain things I'm not going to bother. But since I have to do that income statement up through gross profit, it's a good idea to keep track of certain things. So inventory is one, right? Cost of goods sold is another. It's kind of weird, right? And I guess sales, revenue will be another one. Okay, so we can add accounts if we need more accounts later. Okay, so now we have July 4th. July 4th, pay cash for freight charges related to the July 3rd purchase for $110. Now, when I see the words pay cash, what am I going to do? Credit cash, right? I must credit cash for $110. That means I have to debit something for $110. Now, a normal person would say, well, freight is an expense. I'll debit freight expense. Isn't that what a normal person might assume? But as you've learned now from taking this class, I guess, not everything that happens is normal, or at least it doesn't seem normal at the beginning. But what account should I debit for that $110? And I'm telling you, it's not freight expense. What account would you debit for $110? Well, isn't paying the freight part of the cost of the inventory? So I'm going to debit inventory for that $110. Right? So freight becomes part of the cost of the inventory under this perpetual method, right? And I'm going to make a little note here that we're doing the journal entries under the perpetual inventory method. Okay, now after July 4th comes July 9th. And it says, I returned incorrectly ordered CDs to Wholesale Music and received a credit of $200. So these CDs that I bought here, there was something wrong with some of them. So I returned them. So think about it for a second. If this is what you do when you buy them, shouldn't you do the opposite if you return them? So on July 9th, I'm going to debit accounts payable. Right, and that was for $200. And credit inventory for $200. Okay. Now remember that inventory is an asset. So anytime you increase it, it debits, and every time you decrease it, you credit. Right? Inventory is an asset. So it just follows whatever the same rules that other assets follow. Cost of goods sold is an expense. So you follow whatever the same rules you follow with other expenses for cost of goods sold. All right, so we bought on July 3rd. We paid freight on July 4th. We returned some on July 9th. Now, how much do I owe at this point? How much do I owe for the CDs? Remember, the freight I'm paying to a separate company, so I don't have to worry about that. But how much do I owe Wholesale Music? I bought $2,300 and I returned $200. So how much do I owe them? I owe them $2,100 right now. Right? As of this minute, I owe them $2,100. If I can pay them within 10 days, 10 days would be July 13th. If I can pay them within 10 days, I get to save 1%. And that's exactly what happens in the next entry, July 11th. Right now, July 11th is 2 days early. I'm actually paying earlier than I absolutely had to. Right? What am I going to do? Well, I'm going to debit accounts payable. Right? Because if I owed somebody money and I pay them back, I can debit accounts payable. How much did I owe him? Right? Again, if you want to just refresh your memory, 2,300 minus 200 equals 2,100, right? That's how much you owed. So Debit accounts payable 2,100. Now I'm not going to pay 2,100. I'm going to pay 2,100 minus 1%. That 1%, if you remember from chapter 5, I guess, that's a sales discount to the seller. But how do I record that discount if I'm the buyer? Okay, now 2,100 times 1% is $21. I'm going to be saving $21 by paying this early. If you're the seller, you have that sales discount account to debit. But as the buyer, you don't. So as the buyer, what are you going to credit? You're going to credit inventory. Now, when you first hear that, you say, what? Why do I want to do that? Well, think about it for a second. Why would you credit inventory? Isn't that $2,100 coming off the cost of your inventory? So if someone were to say to you, how much did you pay for that inventory? Well, you didn't pay $2,100. You paid $2,100 minus $21. So how are you going to get that $21 into your inventory account? This is how. So credit inventory for $21, and then credit cash, you're going to write a check, 2,100 minus 21, right? Which is what? 2,079. And let's not forget to put that $21 in here. Right, so that was July 11th. July 12th. July 12th. Sell CDs to customers on account, $5,800 that cost $3,000. Now remember, when you make a sale, you've got two entries to make. The sale, like you normally do, and the cost of goods sold is the second entry that you make, right? So on July 12th, sell CDs to customers on account, debit accounts receivable, $5,800. Credit sales revenue, $5,800. And also on July 12th, debit cost of goods sold, cost of goods sold. That was $3,000. And credit inventory, $3,000. Okay, so let's put that in our accounts down here. Sales is $5,800, credit. Cost of goods sold is $3,000, debit. And inventory is $3,000, credit. Right? Now again, you know, based on what I'm seeing here when you're doing the problem like this, they're not telling you to draw accounts. But my question to you is, how else am I supposed to keep track of these things unless I use accounts? Now, maybe you could do it some other way. Maybe you could just make a list. This increases, this decreases, et cetera, and you might come out to the same answer, right? But again, why reinvent the system? We already know how to use accounts. Just use accounts. Even though they didn't ask you to use accounts, use them. July 15th. Received full payment from customers related to the sale on July 12th. Well, this is the sale on July 12th, so these people are paying me. Debit cash, credit accounts receivable. All right, that was simple enough. All right, now what are we going to do? We're up to July 18th, and July 18th, we're buying again, right? What did it say, July 18th? Purchase CDs on account from Music Supply for $3,100. That's debit inventory. And credit accounts payable. Right, and if we come back here, we have another debit to inventory at $3,100. Okay. Now, we already did that, right? Sometimes usually in an accounting problem, they don't want you to do the same exact thing twice. So you got to start to be suspicious of them and wonder, why are they asking you to do that? Right? So let's just keep that in the back of our minds as to why they wanted us to do that. The first time we did it, we had a return, and then we paid within the discount period. If I had a bet, just knowing these people and the way they think, we're not going to return because we already did that. And we're not going to pay in that discount period. If I had a guess right off the top of my head, maybe I'm wrong, right? What did they say the discount was here? It was 1%. Well, 1% to $3,100 would be $31, right? So if we did pay in time, we would have $2,800. Maybe we'll have a return. I don't know, but let's just be aware. July 22nd. Sell CDs to customers for cash this time. Debit cash, credit sales revenue. Could put the sales revenue right here. Right, and remember, whenever you make a sale, you've got to also record the cost of goods sold. All right, so what was the cost of goods sold? The CDs cost $2,500. Debit cost of goods sold and credit inventory, right? So let's come up here. Debit cost of goods sold and credit inventory. And then on July 28th, we're making a return. Returned CDs to Music Supply and got a credit of $300. So again, when we buy, we do this. When we return, we do the opposite. That was $300. Okay, let's come up to our inventory. $300 over there. Okay, that was on the 28th. And now on the 30th, pay Music Supply in full. Now, remember when we bought that stuff from them? It was on July 18th. If we could pay them in 10 days, we could save 1%. When are we paying them? July 30th. That's more than 10 days. We don't get to save the 1% now. Now we just got to pay the full amount. Now, what was the full amount? Well, we bought how many when we made the purchase? 3,100, and then we sent back 300. So how much do we owe? 2,800, and that's the amount we're going to pay. Debit accounts payable, credit inventory, 2,800. I'm sorry, credit cash, 2,800. Debit accounts payable for the amount you owe. What's the amount you owe? 2,800, right? You originally bought 3,100, you returned 300, you owe 2,800. Okay, now let's go to the accounts and see if we can figure out the balances. So what do we have in inventory? If we add up all the debits and subtract the credits, what does that come out to? 3,400, 2,300, 110, 3,100. Right? That's 8,910 in debits. Subtract the credits. I'm coming up to 2,889. Right? So if I take the debits, add them up. Take the credits, add them up. Subtract the credits from the debits, I get 2,889. Cost of goods sold, if I just add these two numbers together, that's $5,500. Sales revenue, 5,800 plus 4,200, I think comes out to be $10,000 even. Okay, and I think that's it. All right, so now the second part of the problem, right? What did they ask me to do? Prepare an income statement up through gross profit. So what's gross profit? It's sales minus cost of goods sold. So if I was going to do the income statement, I would say the name of the company, CD City, multiple step income statement for the month of July, right? Net sales were 10,000. Cost of goods sold was 5,500. Gross profit is 4,500. Okay. Right. So I guess this was simple enough that you really didn't have to keep the accounts. I always worry, though, that they're going to ask me something that's going to require me to go back and have to like recreate lots and lots of stuff. And then it becomes so complicated. I was just better off keeping track from the beginning. I guess I didn't really have to keep track of inventory. They didn't ask me anything. I had to keep track of cost of goods sold. I had to keep track of sales revenue. So when you're doing this problem for homework, just be aware of that. You're going to keep track of cost of goods sold. You're going to keep track of sales revenue. You're not going to have to keep track of inventory, which is the more complicated, I guess, of the three. And I guess, you know, I mean, I hate to say that when you do things like that, you wasted your time, right? Because it's a good thing to know how to do. But, you know, again, I guess you could say you wasted your time. Okay. That's all I really wanted to do today. We have one topic left. Let me just briefly describe to you what we're going to be doing. Okay, now, again, this is what the difference between what a normal person thinks and what an accountant thinks, right? We need to learn how to come up with the number for inventory. And in so doing, we're also indirectly figuring out how much cost of goods sold is. So keeping track of the inventory, assigning a cost to the inventory also helps us to assign value or cost to cost of goods sold. All right, now here's the problem. With inventory, we've got two things going on. One thing is, how many units do we have? So if we were in the classroom, I always like to use the example of the desks in the classroom, right? If we went around the room and we counted up the desks, let's say there are 30 desks in a classroom. So my ending inventory would consist of those 30 desks. Okay, well, what's the dollar amount for those 30 desks? How much did I pay for those 30 desks? Well, it's not that simple. There are 4 different ways to come up with that number. There are 4 different ways to come up with that number. Now, the way that makes the most sense is the first one, specific identification. I go to each desk, I look at it, and I say, okay, how much did I pay for each desk? Now, if I bought all the desks at once, that's fine. But that rarely happens, right? Because when you're in business and you're selling stuff, you always want to make sure that you have the right amount of stuff in inventory. You don't want to have too much. You don't want to have too little. So as a result, you don't buy all your inventory on the first day and then hope you sell it all out. You buy a small amount of inventory, you sell it, and then you buy some more. So in the course of a year, you might buy inventory, I don't know, 5 times, 10 times, maybe more. What if every time you made a purchase of inventory, you paid a slightly different price? See how that complicates things? So I've got 30 desks left in the room. I bought desks 5 different times during the year, and each time I paid a different price per desk. So this specific identification, which is the one that makes the most sense, because I look at each desk and I say, how much did this cost me? I figure that out, I add it together for 30 desks, and that's the number I use for inventory. If all I had was 30 desks, I could probably do that. But what if I had 300 desks, or 3,000 desks, or 3 million desks? Can I actually go to each desk and figure out how much each one cost me? It would take me a lifetime to figure that out. So to save time, we make assumptions. This specific identification is only used when we have a very low volume, we have small inventory, and the inventory is unique. Like say you were an antique dealer, right? And you maybe only have 10 items in your store, and each one has a story, right? Each one is totally separate and different than the others. You pay different prices for them, and it's easy to keep track of it that way. But once you start to increase the inventory, once you have multiple purchases of inventory where you pay different prices, different terms, etc., you have to use one of the other methods. Now, the average cost method, in my opinion, is the one that makes the most sense but it's another method that's hardly ever used. So let's say I bought desks 5 times during the year, and each time I paid a slightly different price. So I paid $100 on one day, and then $110 the next time, and $120 the next time, and maybe $99 the next time. I averaged those numbers together, and that's how much the average desk cost me, and I multiply it by how many desks I have. I don't know why, but this is a method that is hardly ever used. The reason they give in a textbook is because that average price may not reflect the actual price of any individual purchase. That's the excuse they give. I think it's kind of a weak one, but that's what they give. So we're stuck with these last 2 methods: first in, first out, and last in, first out. First in, first out assumes that you sell the oldest inventory first. First in, oldest; first out, sold first. What are you left with? The newest units purchased. So first in, first out assumes you have in inventory the newest units purchased. So think about it for a second. Wouldn't you try to do that if you had your own business? Wouldn't you try to sell the old stuff first so that you always have the newest stuff there? Right? I mean, what if you were selling bread? You had a bakery and you were selling bread. Wouldn't you try to sell the bread that came out early this morning first before you sold the ones that just came out of the oven? Right? It makes sense. Last in, first out is the exact opposite. Last in, first out assumes that you sell the new bread first, and the bread that you have in inventory is the old stale bread from last week. Okay? Now, I'll explain to you why this last in, first out was created. It wasn't created out of something that made that much sense. It was to save money in income tax. That was the main reason it was created, all right? Because under last in, first out, you usually get the higher cost of goods sold. And if you have the higher cost of goods sold, you have the lower profit. And if you have the lower profit, you pay the less taxes. So last in, first out was basically created for tax reasons. If I had to say which one is used the most, it's first in, first out. And I think somewhere in here, they may even show you a graph or a pie chart or something that shows you how many companies use each method, right? First in, first out is the most widely used, then last in, first out, then average cost, and then a specific identification last, right? No one really uses that. I'm not going to go through the example now. I'll do it next week when we go through it. But just to point something out to you real quick. Here are the transactions for this Mario's Game Shop. On January 1st, they already had in inventory 100, I guess, games. They paid $7 a game. That sounds cheap. 700. Then in April, they bought 300 more games. This time they paid $9 a piece. That cost them $2,700. Then on October 19th, they bought 600 more games. This time they paid $11 a game. That's $6,600. So over the course of the year, how many games did they have? Right? 100 plus 300 plus 600 is 1,000 games. And those 1,000 games cost them $10,000. During the year, they sold 300 games on July 17th. They sold 500 games on December 15th. How many games did they sell? 800. If they had 1,000 and they sold 800, how many do they have left? They have 200 games left in inventory. And what we're going to figure out here is what dollar amount do we attach to those 200 games? And it depends on which of these 4 methods we use. Each method is going to produce a different number. Let me say one thing about inventory also. Inventory, more than any other item, affects net income, right? Inventory affects net income, even though it's an asset, because inventory affects cost of goods sold, it affects net income. Because it's so sensitive, once we pick a method, we almost never change, right? So we start out with first in, first out. We'll probably always use first in, first out. We almost never change. What happens when you change is that you have to go back and you have to restate all your prior financial statements. It is a pain in the neck. It is a labor-intensive job. It means you may have to file amended tax returns. It may mean you have to pay additional taxes. Wall Street doesn't like it. If you're a publicly traded company and you do something like that, the price of your stock is probably going to go down automatically. So once companies pick a method, they don't change it. They rarely change it. All right. So we have to know all four. Right. And when we go through the illustration next week, we'll see how to calculate each one. And then we have a homework problem. And, you know, maybe we'll have time to do an extra problem and then we're done with it. Right. So I don't know. That sounds like a lot for today, right? We did a lot today. Does anybody have any question about anything?
No, sir.
Well, remember that your chapter 5 homework is due Friday, right? Your chapter 5 homework is due this Friday. So make sure you get that done. Chapter 6, you have time. But again, like I always say, don't wait till the last minute. Try to do it as soon as you can. All right, if there are no questions, that's it for today. Be well. Oh, next week we don't have class. Next week is the 11th. That's a college holiday, Veterans Day. So we do not have class next week. Our next class will be on the 18th. Okay? So just pay attention when I send out the notice.
All right, have a good one.
Okay? You too, guys.